Hello students, I hope you're all doing well. Welcome to another video from QuickStudy. This video covers ledger accounting and this is from topic 2, Introduction to Bookkeeping. And in this video, we are going to learn about the purpose of nominal ledgers, receivable ledgers, and payables ledger. And we'll also learn about how you will record transactions in ledger accounts using double entry principles. So firstly, we will learn about ledgers. So what is the ledger? The ledger is basically a fundamental component which is used in double entry accounting systems. They are basically a collection of accounts which will record or provide a detailed record of all the financial transactions for a business. And ledger accounting is a slow and methodical task, not as interesting as one would find it. But it actually emphasizes the importance of accuracy and attention to detail when you're working with ledgers. And when it comes to posting, you would have to transfer information from the books of original entry. Remember, like we've already discussed in the previous videos, because initially from a source document, you'd enter the transaction onto the books of original entry, and from that, you'd have to transfer those balances or post onto the relevant and appropriate ledger accounts. And this is called basically posting. And there are different types of ledgers, which are basically categorized. And those ledgers are receivables ledger, which are used to record the transactions for your credit customer. So when you receive money from your credit customer, you'd record it into the receivables ledger. And then you've got the payables ledger, which is used to record transactions related to paying off your credit suppliers. And then you have the general or the nominal ledgers. So these are basically, it's a comprehensive ledger which will include all other accounts. And these are not explicitly categorized to the receivables or the payables ledger. And the examples for general or nominal ledgers may include your assets account, your equity account, your income account, as well as your expenses account. All right, students, now that we have just discussed about the importance, or what we've just discussed, the ledgers basically, and how it's important to post entries into the ledgers using the double entry system, right? So let us look into the double entry system in a bit more detail. So what is the double entry system? Double entry system is basically a bookkeeping system and a fundamental accounting principle which requires every financial transaction to be recorded as two separate entries, which are represented as a debit entry and a credit entry. I'm pretty sure you're familiar with these terms. Debit entries and credit entries are most popular accounting terms. And this system will basically ensure that the accounting equation, which is assets equals to capital plus liabilities, will remain balanced. And every transaction will affect at least two accounts. And this is the core principle of the double entry bookkeeping system. And when it comes to recording transactions into accounting records, you need to know that these transactions need to be backed by source documents. So the transactions will be based on supporting documents like invoices, your credit notes, checks, receipts, etc. And business transactions will involve money or money's worth. Any transactions which does not or cannot be represented in terms of money do not find a place in the books of accounts, which is also related to an accounting concept which is known as the money measurement concept. So we'll look at some examples with double entry accounting system. Say for example, if a business buys stationery which is valued at Singapore dollars of $40 worth and pays for it by cash. So two things will happen. First of all, the money in the business's cash account will decrease by 40 Singaporean dollars, right? And then the business will acquire stationery to the value of 40 Singaporean dollars. And what happens is basically you will debit your stationery account since you're receiving stationery, and you will credit your cash account since you are paying cash, which decreases your asset value. So this entry will go on to the credit side of the cash book, and for the stationery, you'll record it on the debit side of your stationery account. Alright, so here are some basic rules for the double entry system. And you need to keep in mind, once you get a hold of these 4 key rules, you won't have any other problems related to double entry accounting systems or journal entries, like we'd like to call it. So the very first rule you need to remember is that every transaction will affect two things, which is the very core principle of the double entry, which means that each entry would have to be recorded, each transaction would have to be recorded as a debit entry and as a credit entry to maintain the balance of the accounting equation, right? And the second rule is that the order doesn't really matter. So it doesn't really matter whether you put the credit entry first or the debit entry first. And so which account do you debit or which account do you credit? Usually assets or expenses these are items or categories that are debited to increase the items, and then while the credit items are, or you credit the items like liabilities, equity, or income to increase these items. And in short, if I'd like to phrase this for you or summarize this for you, it would mean that to increase or to record assets, you need to debit asset accounts, and to decrease asset accounts, you need to credit asset accounts. And when it comes to liabilities, if you want to increase your liability account, you need to credit it, and if you want to decrease your liability account, you'd have to debit it. And when it comes to equity, in order to increase your equity, you need to make a credit entry to your equity account, and if you want to decrease your equity, you have to debit your equity account. All right, now let's look at the accounting equation in a bit more detail. So the accounting equation is the foundation of the double entry accounting system, like we've already discussed, and this equation can be interpreted in different ways. Say, for example, the accounting equation is the owner's equity, which is the capital, equals your assets, which is the cash in your hand. Now, if capital is equals to assets, now, say for example, the business buys an inventory of goods and pays for them in cash, then the accounting equation would be capital, which is the owner's equity, equals your assets, which is your cash in hand, less the amount that you have spent on inventory, plus the inventory of your goods. So the new equation would be capital equals to assets plus inventory of goods. And the accounting equation is basically the same, except that you have now two assets, which is your cash in hand as well as your inventory of goods. And if a business incurs a liability, say for example, the business has obtained a loan from the bank, then the accounting equation will look like this. Assets equals capital plus liabilities. And an alternative way of using the accounting equation could be capital equals to assets minus liabilities. So basically, you'd be able to move around the items from one side of the equation to the other, right? And the capital or the equity is always equals the assets less liabilities. And using the example, we can assume that the capital or equity is, say for example, 100,000, and if you deposit this money into the business's bank account, and in addition, the business obtains a loan from the bank for 5,000 pounds, the accounting equation could be capital equals assets minus liabilities equals 10,000 pounds, right? Or 100,000 pounds, sorry, we have discussed as in the example. And this could be calculated as your bank value, which is 100,000 pounds plus the loan of 5,000 pounds that you've obtained from the bank, and your bank loan amount would now be 100,000 pounds. Your bank account amount would be 100,000 pounds plus 5,000 pounds, which is basically 105,000 pounds. All right, now let's look at an example of double entry accounting for cash transactions. So like I've already mentioned, double entry means that it is an accounting system where every transaction is recorded as two entries with a debit and a credit entry. So when we're talking about cash, in accounting terminology, cash may include physical cash as well as checks as well as electronic transfers. And an example of a transaction could be a transaction where the proprietor starts a business with 50,000 pounds in cash. And what would be the effect of the transaction? You see, if an owner starts a business with 50,000 pounds in cash, it increases the asset of cash as well as increases the owner's equity. And the journal entries for that would be you debit the cash account to show the increase in the asset as well as credit the equity account to show the increase in the owner's equity. All right, now that you have looked at how cash transactions work, you also need to know how does credit transactions work. So in business and in accounting, of course, there are a lot of transactions which are made on credit. So what are credit transactions really? Credit transactions are basically where items are bought for but paid for later. And the terms and conditions actually depends on the supplier's requirements for the payment, and this is usually made within 30 days. And why would you want to do business on credit? So there are many benefits. First of all, it will provide you with short-term cash facilities. And it also helps improve the business's cash flow since you do not have to immediately pay for the goods that you've bought. So you'll be able to buy the goods from your supplier on credit. You might also be able to sell them before you make the payment to your suppliers. So you don't need to put extra money away from your pocket to pay for the supplier. And another benefit of making transactions on credit involves getting cash discounts. So cash discounts may be offered as an incentive for early payments. And you'll also need to remember that when you're dealing with transactions on credit, a liability incurs. So when customers will receive goods on credit, they will owe the supplier for the cost of the goods that they have purchased. Now we will look at an example of how a credit transaction occurs, and it actually involves the purchase of goods and how this is posted. So an example of a transaction is where J. Hussain, a person, is buying goods costing $2,300 on credit from B. White, and the effects of the transaction. So J. Hussain is buying goods worth $2,300 on credit from B. White. The effect this has is that it increases the assets of inventory for J. Hussain, right? And at the same time, since J. Hussain is purchasing goods on credit, so it also increases his liability to B. White, right? And the journal entry for that would be you have to debit the purchases account to increase the inventory asset, as well as credit B. White's account to increase the liability that J. Hussain has just incurred. Alright, now that J. Hussain has purchased goods on credit from B. White, he would have to make the payment eventually, right? So what are you going to do, or how is that entry recorded? So what happens when J. Hussain makes a due payment to B. White, right? And how is this entry recorded? So say, for example, that the transaction is something like this, that J. Hussain has paid B. White for $2,300 in full settlement of the goods that he has purchased on credit. The journal entry for that would be you'd have to credit the bank account to show the decrease in the asset since you're paying it from your bank account. And you'll also have to debit B. White's account to reduce the liability that J. Hussain had initially incurred when he had purchased goods. Now that J. Hussain has made the payment, you decrease the liability, right? Alright, now as we have talked about the transactions which involve purchasing goods using cash or purchasing goods on credit. So there are purchase transactions, there are sales transactions, but there are transactions which involve the return of goods, right? So what are returns really? So purchase returns or revenue returns will occur when the goods that have been bought are returned to the supplier. And this could be for many different reasons. It could be because the goods that you have sent to a customer may not be of the correct specification, or the goods that you have sent may have been damaged in transit, or the goods are of poor quality. Now the customer do not want these goods for these reasons that I've just mentioned. So the customer would return these goods to you, right? And these returns are in the form of a transaction. So the original purchase or sale would already have been entered into the double entry system, right? So the return of the goods must also be entered into the system. And purchase returns will represent the goods that have been purchased and returned to the supplier for one of the reasons that I've just mentioned before. So these reasons would apply to purchase returns as well as sales returns. Alright, now we will look at an example which involves the return of goods, which is basically you have purchased some goods, now you are returning a particular portion of the goods that you purchased to your supplier. And now the example of the transaction could be where goods that have been previously bought for £540 are returned to the supplier. And so the supplier in this example is iGlover. So what effect does this have? What effect does this have on your records? So first of all, since you're returning goods to your supplier, it will decrease your liability to the supplier, right? So the journal entry for that would be debiting iGlover's account to reduce the liability. And you'd also have to make an entry on the purchase returns account. So on the purchase returns account, this is a credit item since it decreases your assets, right? So on the credit side of the purchase returns account, you post iGlover, and the value would be $540. And on the debit side of the iGlover account, you post purchase returns as $540. So besides purchases and revenue transactions, a business may also transact on credit, and transact on credit for the expenses that they have to pay for, right? So when a business will receive services or goods, they might actually agree to pay for it at a later date. An example of a transaction is, say for example, a business asks Banco's Garage to service their van and receives an invoice for $246, which is due within 30 days. Now, what effect does this transaction have on the business records? So the journal entries would be you'd have to debit the motor expenses account to record the expense, right? And then you'd also have to credit the Banco's Garage account to create a liability for the amount that you owe to them. All right, now that we have just discussed that a business may actually receive a service and pay for that particular service as an expense at a later date. So what transaction or what record are you going to make for a particular transaction where you have a liability to pay for an expense? So the example, like we've already discussed, where you've received some service for servicing your motor van, now you'd have to pay the amount due to Banco's Garage, right? The amount due was $246. And to pay off the outstanding amount, the journal entries would look like this. You'd have to credit the bank account to show the decrease in the asset, and debit the banco's garage account to reduce the liability. All right, and when you are talking about revenue and purchases in accounting, you need to understand these terminologies and how these apply to accounting. So first of all, when you're talking about revenue, your revenue will actually come from the sale of goods that the business typically deals with and buys with the intention of resale. And when you're talking about purchases, we are talking about goods that a business will purchase with the intention of selling them, even if they are altered or added to or used in manufacturing for whatever reason. For example, a business that trades in computers will consider computers as raw materials, but a motor van bought for business use is not considered a purchase because it is not intended for something other than resale, because a business is not purchasing a motor van to resell it. They're going to use it as an asset, so that is not treated as a purchase. Whereas a business that deals in computer, who sells computer, when they're purchasing computers, that is regarded as a purchase. All right, now that you understand the importance or the distinction between purchases and revenues in accounting terminology, you also need to understand the comparison between cash and credit transactions for purchases and revenue or sales. So when you are purchasing goods that are paid for immediately by cash, what do? You basically debit the purchases account and credit the cash account. And the complete set of entries for purchasing goods on credit can be broken down into two things. So first of all, you'd record the purchase of goods, and secondly, you'd have to record the payment for them. So the entries for the first part, where you're purchasing the goods, you'd record as debiting the purchase account and crediting the supplier's account. Later on, when you pay for the goods that you've purchased on credit, you'd make the entries where you're debiting the supplier's account and you're crediting the cash account. And with the cash purchase, you have to keep a copy of the supplier's account. Keeping a copy of the supplier's account is basically unnecessary because you're paying for it in cash, so you can just record it immediately. And since it passes directly from the buyer to the supplier immediately, there is no need to keep a record of the indebtedness or the money that you owe to a supplier. And in the credit purchase, the record should compare money owed and the payment that has been made. All right, now that you know how you prepare ledger accounts, you also need to know how or why you need to balance them. So a business will use a monthly procedure to make sure that there are various accounting issues that can be checked, because you need to balance the account, because you need to know what is your cash account balance or the bank account balance, how much money do you owe to your trade payables, or how much money does your trade receivables owe to you or your credit customers. You also need to know what is the total value of the assets or the equipment that you have. You need to know what is the total expenses that you have incurred for a particular period of time, as well as the amount of inventory that you have in balance, the revenue figures, the equity amount, the drawings, so on and so forth. So there are plenty of different kinds of T accounts that we prepare in accounting, and you need to know the total balance after a particular period of time, which is why we need to keep a balance of these accounts. Alright students, now we'll take a look at how you will balance a bank account, and this will actually apply to every other T account that you will do. So as you can see here, we have a business bank account, and here you have some entries. You have entries for equity, revenue, purchases, rent. And then you have a balance CD and you have a balance BD, right? So how does this really work? First of all, after you've made all these entries, which I have just highlighted, what you're going to do is basically make a total of these amounts. Now, when you make a total of these amounts, do not write the total into these accounts immediately. What you're going to do is basically write the figures lightly in pencil or in a different place. So what you need to look for is the larger value of the amount. On which side? Do you have the larger value on the debit side of the T account or on the credit side of the T account? On whichever side the value will fall short, what you have to do is deduct the smaller amount from the larger amount to find the balance. And in this example, on the debit side, you have a larger value. We can already tell from looking at these values that here you have $20,550. The total will be greater than 2,400 plus 500, right? So the difference between 20,550 minus 2,400 and 500 would come down to 17,650, and this is basically the balance, which is recorded as balance CD, which stands for balance carried down, and the date for that will always be at the end of the month. Now, what do we do with the balance CD? This balance carried down is forwarded to the following month. And as you can see here, November 1st is the following month, and here you have a balance BD, which means balance brought down, which is the balance brought down from the previous month. So where did this value come from? This value came from the previous month's balance C. And this is how you can balance a T account. Alright students, now we are going to take a look at 3-column accounts. So what are 3-column accounts? These are accounts that can be shown using 3 columns. You have you just get the highlighter here. You have a debit column, you have a credit column, and then you have a column which shows a balance on the account, and whether it's a debit balance or a credit balance. So here you have the T Baldwin account. So here you have the date on May 1st, you sold goods worth 1200 euros, and this is the balance that you have, which is a debit balance, right? Then on May 12th, again, you sold goods worth this much, and now the balance has increased. So how did this increase come about? It's basically this 411 euros is added with the previous balance, right? Because it was a debit balance. If it was a credit balance, then it would have been deducted. And similarly, on May 19th, there was a bank amount, and this is what? A credit amount, which means that you have paid out money. So this 1200 is deducted from the balance from at the previous date, which is 1611. So when you deduct 1200 from 1611, you will get 411 pounds. So you have it as you still have it as a debit balance. And then on May 24th, you have revenue again worth 260 pounds, and now your total balance is 671 pounds. How did you get this? You basically added 260 with the previous balance of 411 pounds. Now you have a total of 611 pounds, which comes down to as a debit balance. Alright students, with that we have come towards the very end of this video, and to give you a short recap of what we have covered so far, we have talked about the following topics in this video. We have talked about the purpose of nominal ledgers, receivables ledger, as well as payables ledger. Furthermore, we have discussed how you record transactions in ledger accounts using double-entry principles. And students, with that, I'd like to thank you for watching this video. And if you've liked this video, do subscribe to our channel since we post regularly on different topics and subjects that can help you ace your GCSEs. And of course, if you'd like to know more about us or our online tutoring services, do visit our website at www.quickstudy.uk. Thank you.